Alright, Advanced Gap Course, Chapter 4, Candlesticks. I love the candlesticks. Candlesticks is kind of the formation built upon supply and demand for entries. Alright, let's get started with Chapter 4. So candlesticks are the foundation of our trading style and trading gaps. We use the Japanese candlesticks to identify supply and demand levels being produced intraday and also to the left for previous supply and demand levels. All we need is a chart of price bars because they tell us how other traders have reacted or acted and what they believe in the price action, thus giving us expectations about what's to occur in the next moment or the next minute or what's occurring right now. Candles speak and tell us about the war that's going on. I like to call it a war between supply and demand and the relationship in each time frame. So it's telling you if the candlestick ends in red and closes at the bottom, they tell you the bears won. If it closes at the top and is green, it tells you the bulls won. So it's always giving you information and that you can determine your next move or your next entry or your next trail out or whatever profit taking arena. Our trades and decisions are based on arrangements of candlesticks, thus bringing us a pattern that we can recognize. So there's a lot of pattern recognition going on here, and the more you do this and the longer you look at charts and the longer you study charts, even if you don't take the trade, the more you're going to build a history inside of yourself of pattern recognition. You're going to see that. I know that pattern. I know that setup. I know what to do. I know to go long. I know to go short. Candlesticks can be very accurate at forecasting what may happen. Now, nothing is a complete accuracy of determining what can happen because as a trader, as we all know, we have to have the mindset that anything can happen, right? One chart, one candlestick may say something happened, another one completely reverses the other way, news comes out or whatever. But remember, we always use candlesticks as determining our move in the market, entry, short, long, stop, target. But we also are always aware that anything can happen, which keeps you in a place of going forward as a trader. So here's a candlestick. If you're any bit new to trading, I'm just going to go over some brief elementary candlestick formations here. So open here, we talked about the bulls winning with the green, right? So it opens at the low in whatever time frame, say 15-minute time frame, and it closes at the high. That's a bullish one, right? So we got supply and we got demand. And the demand won, the buyers took over, took control, they bought the price up. Now to the right, we have where the bears win, where it opens at the high and it closes in that time frame at the lows. So telling us that supply is overtaken, sellers were winning on that time frame. Okay, so bears win green, bulls win green, bears win red. Alright? Red, green. So what are candlesticks? Candlesticks are a representation of who's winning the disagreement about what is a high and what is a low, or what is the price that we want to have it at, right? So candles are pictures / x-rays of supply and demand in a unit of that time frame. Now we are using a 15-minute time frame, 30-minute time frame, and 60-minute time frame. So you can always change the time frame to change the picture. So the higher the time frame, the higher the confidence and the more solidity of what is occurring. So if you go to 60-minute time frame, so hypothetically if you go off the monthly, weekly, daily, 60-minute, 30-minute, 50-minute, you work your way down. So the higher the time frame, the higher the confidence, the higher the... So like you may have a bearish weekly chart, but you could have a bullish 2-minute chart. Okay? So you have to stick to the time frame that you're in, execute the time frame that you take the trade off of the 15-minute chart, 30-minute chart, 60-minute chart, and don't deviate and change the time frame because it'll mix your signals in your brain and cause confusion. So stick to your time frame off the candles you're trading off of. Okay, candles speak. Listen to the candle language. Do not assume or try to guess the outcome of the current candle. What I mean by that is a candle is not finished till that unit of time frame is complete. So you could see like a bottoming tail in the 15-minute chart of the candlestick, but but the candle hasn't closed yet. I mean, you got 2 minutes to close. Well, that bottoming tail or topping tail could go away in those 2 minutes. So wait patiently for the candlestick to close. Now I have on my trading platform alerts that tell me when the candlestick's closing, and so I'm aware of the certain type of setups I'm looking for. I get alerted to. Okay, so I recommend setting it up yourself also. So candlesticks do speak. We need to listen to the language. So for example, on the top row, we got bullish change of bar from green to red. The 3 or more consecutive red bars followed by green bar, just showing you there's a change in momentum, change in shifting. So 3 down. This isn't a setup. This is just showing you a change is occurring. So just paying attention to it. Okay, so on the bottom we have the bearish change of bar from green to red, and these 3 more consecutive bars followed by a red bar shows you there's a shift in momentum. Just be aware of what's going on in the time frame you're trading. Okay, so like if on the bottom row, if you were long on the first green bar and you get up to the 4th bar and it's turning red, what are you doing at that point? You are objectively tightening, taking profit, trailing your stock in the money. You're trading the money. So you're always paying attention to what's going on. You're not a flyby. What's going to happen? I'll just close my eyes and see what happens. You have to. You're a trader. You're evaluating the price action off the candlestick. It's keeping you in the trade. It's getting you out of the trade, or it's getting you in the trade. So, and we want to pay attention to specifically in this advanced gap course, the narrow range bar, the doji bar, the tight range bar, and these are my favorite bars for entries. And they show you something's occurring. Okay, these bars in which the body of the candle is small relative to the overall length of the candle, they could have tails on either side of the body. The message is always the same: things are slowing in momentum, and it could be signaling a shift. So, to the left, the narrowing bodies, we see the downward price action. Hypothetically, you're short the trade on a gap down. Then you begin to see a bottoming tails form. What you begin to do is you begin to trail or take profits, and the same to the right. You got long the stock on the first green bar, and now it's starting to show you a bit of change by a topping tail. So pay attention, read the language. We don't know what's going to happen next, but we do know that we can control our trade based upon what is occurring in the moment, based upon the time frame we are trading in, 15, 30, 60-minute charts. So narrowing ranges, narrowing range bars, several candlesticks in which the difference between the highs and the low is narrowing. So when you have on the left, we have a wide range red bar. Then you have a bar that's a little bit smaller and then you have the 3rd bar, which has a little bit of a topping tail, and then you get the 4th bar, which is a tight body. If I'm in a trade and I'm short and I'm seeing that tight body start to form, I'm either trailing. I'm going to trail over that bar. That means I'm going to stop out in the money over that green bar to lock in profit. Okay, and then the same on the right side. You're in the trade at the first bar. Boom, boom, you get moving up. You're trailing, bar by bar, slowing, keeping you in the trade. So pay attention to the candlestick language. Narrowing ranges, here's an example of a trade. Several candlesticks bars in which the difference between the high and the low is narrowing. The language is still the same. Momentum is changing, and it happening in the moment. So anytime we see, then remember the candlesticks are speaking a language to you. And as a trader, the more that you trade, the more that you look at charts, the more that you will see the message. It will speak to you. You'll remember, yes, I know what that candlestick is. It's telling me something's happening. There's buyers stepping in. I need to cover my short. Topping tails or bottoming tails, they tell us something's occurring. These are big signals in day trading on the 15, 30, 60-minute charts. I'd probably say the narrow range bar, which we just talked about, and the bottoming topping tail are probably some of my favorite setups. Okay, so a topping tail is what we're looking to the left here, normal or wide range bar where the price is higher than it finds sellers forcing the price lower, thus creating a topping tail. So that means it was up at that price action. But when the bar closes in that time frame, it closes at the low, and that therefore creates what we call a topping tail or a wick. Okay, and that shows you that there is sellers up there, or people are taking profits up there, and so there's distribution being added and supply being added. So if you're long the trade, you want to be joining them, because you can't move the market, you're just moving with the market. And then to the right we have bottoming tail, which is just the opposite of a topping tail. It shows you where demand is, where people are buying. If a stock is selling and then all of a sudden people step in or start to cover, or there's real buyers there, it shows you demand's added, and it shows you that people are accumulating the stock in that area. So pay attention to the price action of the candlestick. It's huge clues for entry, for trailing, and for taking profit or stopping out. Also, one of the things you want to do as a trader is you want to look for fluid moves versus overlapping. I think this is one of a lot of traders get caught up into, is they try to see things that aren't there. And for instance, let's talk about the fluid move to the left first. The fluid move means bars not overlapping, providing high quality setups. Why are they high quality setups? Because when a stock moves in a fluid move down or up where the bars aren't overlapping, it creates an easy avenue for the stock to retrace because there's less resistance to the left. And those are the type of setups we're looking for. Now to the right, we have the indecision choppy. And what I always classify those as called a toad in a blender. Red, green, red, red, green, red, red, green, red, green, red, green. It just tells you no one's committing on the long side. No, and if they are, they're very short term. And no one's committing on the short side because they're in short term, they're in and out. So these type of setups to the left you want to avoid, right? You want to look for more of the fluid moves to the left. And we'll go over that more in detail as we proceed in the seminar. Alright, so candlesticks speak a language and give us notice. The key is we have to listen to the language in the bars. So we see that on the left we have two red bars with the bottom, one with a bottoming tail, and then the second one goes inside. Okay, so that's very important to notice. So let's just hypothetically say this is a 15-minute chart, okay, on a gap down, and the first 15-minute bar is a bottoming tail. So what's that telling you? I know what you're thinking. It's telling you that there's buyers there on the gap down. So if I'm looking to short a gap down that has a bottoming tail, I've just canceled that in my head. I'm not looking to short that. See, you have started with the preliminary of what you want to do in the pre-market. A gap down could go lower, but there's a chance it could go the other way. It could fade. So you're reading the price action in the moment. So bottoming tail, first signal, there's accumulation. There's a demand down there. Now the second bar is even more important because it's showing you the price action isn't going over the previous high, but hasn't broken the previous low. Okay, so as a trader, this setup here is what I want to do. I want to get long over the inside bar on the 15-minute chart. So I'm going to get long over the second bar because I think this thing's going to reverse and go back towards the gap fill. So what happens? Boom, it goes up. Okay, and there's two ways to trade this. So you've taken a reversal on the fade on the gap down, and now it's produced a wide range bar, but potentially in the move. We wait for the bar, and then what's the fourth bar come in? Shows you that the stock is narrow range, topping tail, and then you could get short. Boom, and you see how it plays out to the left, right? So I'm giving you both scenarios because as a trader, you're looking for what's telling you in the moment, not just one thing. I'm only going to short gap downs. I'm only going to go long gap ups, because if you do that, I mean, you'll get trades, but you got to think in both sides of the avenue. If a stock gaps up, it could potentially be a stock that fades out. It goes back towards the gap or retraces towards the gap fill. Or if a stock gaps down, it could potentially be a retracement towards the gap fill. Or it could be a short. So stay in the moment, read the candles, trade the trades. This is how you'll grow. This is how you'll learn. Okay, so here we go. We got more of X-rays of a candle. Candlesticks give us, as traders, X-ray views in a time frame of supply and demand. So basically, again, our core concept is supply and demand. Is a stock being overtaken because of a gap with supply, sellers, or is it being overtaken with demand as buyers? So all we can do is read the time frame. So we see the stock, the green candles produce and show us the bottoming tail shows us demand, the green wide range bar shows us demand, narrow range bar shows us tightening. Anytime you get a narrow range bar, try to think in terms of compression, right? Because the next move potentially could be explosive to the upside or to downside. Because it's just like when you press something really tight, it potentially could explode, right? So think of narrow range bars as being something you want to trade off of. So wide range bars show us two things: they ignite and move, or in a direction, or in the move. So remember that wide range bars, typically for a gap, or I call them the mother bar or the anchor bar. So, and I like to think of them as an anchor mother bar because they're going to kind of support my setup, right? So the first bar on the 15, 30, or 60 minute chart is a wide range bar. This potentially could create a money pocket we talked about earlier, or it could create a momentum to new price action. So I know we had talked about the money pocket is basically a range of the price that you look to trade into retracement. Well, a wide range bar can ignite a move if the next bar is inside or is narrow range. We'll go more over these setups as we proceed into the seminar. So I'm laying the foundation with candlesticks here. Okay, so we just finished the Candlesticks chapter 4.